The mistake I made, Kyle, and the mistake I have seen other people do right now is to put debt on properties where they can't control the change in value. Because if you do that, the market may do what you don't want it to do, whatever that is, and you will end up keeping that debt in place for longer than you want it to, and it'll stunt your growth. So if it's a longer term hold that the market is really in control of your value, equity is what you want, because investors will get in, they're on the ride along, they make what you make, everybody wins, everybody has to hold their breath a little bit, that kind of thing.
Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate sponsors and syndication experts from every corner of the United States. We teach you how to harness the power of passive real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
What's up, guys? Welcome to episode 120 of the Creating Wealth Podcast. I am your host, Kyle Curtin. I am a co-GP specializing in investor relations and capital raising for multifamily sponsors. Today, we get the great pleasure of chatting with Matt Faircloth. Matt is an extremely experienced real estate investor, co-founder of the DeRosa Group. He has tons and tons of years of experience doing all kinds of things, from flips to office to multifamily apartments. He's built a very large portfolio of over 1,000 units, raised millions and millions of dollars. He's the author of this phenomenal book right behind me, Raising Private Capital, How to Build Your Real Estate Empire with Other People's Money. And we're super excited to have you on here, Matt. Like beyond honored, man. We were talking a couple minutes before the show, guys, and I was just telling him, I'm like, the amount of knowledge that I've pulled from that book alone is indescribable. So
thank you, brother.
Super excited.
Appreciate that. Yeah, I appreciate that. It's an honor to be here on your show. It was fun writing that book, putting a lot of my personal stories and just stuff that I learned over the years of real estate investing in there. And super proud to announce, man, we're sitting here late July 2023, and we're approaching the 5-year anniversary of Raising Private Capital being published. Like 60,000 copies sold of that book. I've talked to multiple people. I got one buddy who read the book and applied the principles, and now is living the van life with his girlfriend on the beach in Cabo.
Wow.
Okay? And he's able to work and all that from down there. But because he applied the principle Raising Private Capital, got some bigger real estate deals done, is able to, and is making enough passive that he's, living in a van down by the river now, but in Cabo, right? And multiple people with success stories, millions of dollars raised through the principles of the book. And super proud to tell you, Kyle, that the new edition, the revised edition of Raising Private Capital just dropped literally yesterday on Amazon. You can now get the new copy of it.
Perfect.
And I'm really grateful that Biggerpockets gave me another shot to add more value to people by writing more chapters of the book. And I'm blown away that Pace Morby agreed to write the new intro.
Wow.
For the book, and he's the man. He is a force of nature. So a fantastic guy, and he wrote the new foreword for the book, which is super amazing too. So everybody's gonna go check it out.
Absolutely, that's wicked cool, man. I know that was good timing for the interview. Oh yeah, it dropped yesterday. Beautiful.
Yeah, I know, right? Literally, just so happened to I didn't time it like that, but you happen to be the first person that I get to say it public to. Hey, just so you know, new episode, a new version just dropped. So here you go. You got an exclusive.
Cool. But yeah, man, let's kind of jump into your story a little bit. Kind of how you got started in the real estate space to kind of jumping into the multifamily sector, kind of what you're up to now, besides dropping another phenomenal book.
Working on more, origin story, is, let's see. I was a traveling engineer. It was my job, and my girlfriend, now wife of 18 years, put Rich Dad, Poor Dad in my hand. got me into playing his board game, Robert Kiyosaki's board game Cash Flow. Became like, borderline addicted to it and started getting all my buddies to come over and play with me and stuff like that, play the game I was playing like on a weekly basis. And it just really blew me away on what was possible with regards to financial independence and buying assets versus buying doodads, and really opened my mind to a lot of possibilities. And so it was a really great journey. And I ended up buying a little single family home, moved into 1 bedroom, rented out the other 2 bedrooms to 2 of my buddies. Each of those guys were paying me $500 a month and my mortgage was $940. So I was making $60 a month and living there for free, while I had a full-time day job. And in 2 years, paid off all my student loans, paid off all my credit cards, got myself bad debt free, and started buying more real estate. And then I was hooked. And when Liz and I got married, we were able to quit. I was able to quit my job and go full-time in real estate investing, and started the DeRosa Group from there, our company.
All right. That's phenomenal,
Yeah.
man. You definitely can't beat the house hack strategy. It's
Yeah,
a really beautiful thing.
I was doing house hack before it had that cool name, I just thought that was just renting out rooms in your house, now it's got a really cool name, and it's got its own movement behind it. But what's funny, Kyle, is that like people forget that it's almost every American, their living expense, to put a roof over their own head, be that rent, mortgage, whatever, that is by far their largest expense in their expense bucket, right? If you even chart, and to this day, my mortgage at my home I live in now is my largest expense. It's the largest check I write on a monthly basis, right? Except for maybe to Amazon. I don't know. Maybe that's a close second. I don't know. It's like, do I send Jeff Bezos more money? Or do I send my mortgage company more money? I don't know. One of the two.
Depends.
Yeah, it depends on the month, right? But anyway, if someone can eliminate that bucket of their expenses through house hacking, you're so much closer to financial freedom, and you can spend that 25-30% per month of your earned income on something else, be that your bad debt, be that financial freedom, be that just working less, and living life, or whatever it is. It's amazing. It's an amazing equation.
It totally is, man. Yeah, I ended up I'm up in Massachusetts, and I ended up using FHA, house hacking a 3-family in like central Mass, and then moving back into my parents' house, which is where I am today. And you definitely can't beat that strategy, man.
Listen, you house hacked and then you moved out of the unit that you were in.
Yep.
Right. Okay. Yeah, I did that too. I ended up moving out of that bedroom. Yeah, because when Liz and I got married, I kept owning the house. So I rented out the one room that I used to have to another buddy of mine. Actually, I started meeting people online. Back in the day, there was this website called roommates.com or roomiematch.com that you could meet roommates on.
Wow.
when you wanted to find a roommate. And typically it was for people like, I need to get a 2-bedroom because that's what I can afford, and I'm going to rent 1 bedroom. I'm going to live in 1 bedroom, and somebody you meet online is going to rent the other bedroom. And so I would go on that website and meet people, interview them, the whole thing. And that's how I found replacements for the units over time in that. But I ended up moving out of that one, moving to Jersey with my wife, and held that house for a couple more years. But that was an FHA mortgage too. So
absolutely, man.
Yeah.
You gotta love it.
You gotta love it, man. I wish we had bought, when Liz and I got married, if I have any regrets at all, I don't have any regrets ever in life, but the only regret that I have maybe is by her and I not moving into a duplex when we got married, to just buying a duplex or a 3-family like you did, and continuing to live lean and having other tenants pay our rent, pay our mortgage each month. We didn't end up not doing that, but that would have been even better.
I hear you, man.
Yeah.
But yeah, so I'm super excited to kind of jump in, man.
Wherever you want to go, brother. I'm an open book.
Yeah, so definitely absolutely, like we mentioned, a very big fan of the book, especially when it comes to like the capital raising component. I'm a bit newer into the space in like the syndication world and the capital raising and that type of thing. But yeah, man, like there's like so many things that I loved from that book, including especially like making your master list. I have like my spreadsheet on my phone and like everybody categorized and stuff like that. Really cool stuff. So when, I guess, did it kind of, or I should say this, take us kind of through the first time that you approached I forget if it was, I read the page in the back of the book there with the two gentlemen that you raised capital from, like outside of your family. I guess kind
Yeah.
of take us through the story of like raising for the first time. Like, did you have a track record at that point in
No. Well,
time?
yeah,
Or
we had a track record, but I wasn't like, going around doing. I wasn't doing what I train people to do now, which is to raise capital intentionally, right? I
yeah,
kind of stumbled into it, and I believe that people could scale into raising capital much faster than I did if they do it more intentionally. Because I just kind of like, stumbled in and then slowly expanded organically through it. But if I had to do it over again, I think that I would be able to do it much more aggressively, which is what I've taught people to do. Now is like skip some of the mistakes that I made, and some of the stumbling blocks that I made personally. I can teach people to get around those. Right. So when we first started, we did our original deals with me and Liz's money and with immediate family, like my parents and her mom and dad. What they did was they didn't, they weren't like independently wealthy and just gave us millions of dollars to go put to work in real estate. They had their primary residence was paid off, right? Because they're older and they had just done the right thing, done what the American dream or what a lot of the financial gurus and Dave Ramsey and Sue Zorman tell you to do, pay your house off, right? So they abide by those rules, send a little extra to the bank each month, and pay their houses off. And so they had free and clear real estate, which allowed us to put a small line of credit on those houses that enabled us to get going. Now, we made the monthly payments, but that house was a guarantor for our line of credit. And I think you can still do this. I'm not sure if you can or not, but this is a while ago. We built a portfolio of about 30 units with those lines of credit and with our own cash too. And you did do the BRRRR strategy, yet another strategy we did before it had a cool name like that. I just thought it was buying properties and then refinancing them, but the BRRRR, it's a way better name than we had for it. So we did all that, and got up to about 30 units. And then my wife was talking to somebody she went to college with, talking to him about what we were up to in our businesses. And I had her full-time day job and I was running our company. And he says the magic words to her, which is, geez, real estate investing. That sounds so cool. I wish I could do that too. I just don't have the time. Right. Because this guy that she went to college with is now a financial planner on Wall Street and working 80 hours a week, just printing money, making lots and lots of money for himself, but working 78 hours a week to keep it going, to keep the magic going. Right. The golden handcuffs. Right. So, yep. And a lot of people that are wearing golden handcuffs in life are the best investors for people like you and me, because they want to do what you and I do. They read Rich Dad Poor Dad. They're aware that there's another way, but they just don't have the time. And so me and this person sat down when I took the train up to Manhattan, got coffee with him. And he was just like, well, I told him what you're up to. And he goes, well, what if I give you 50K? And I was like, you're right. That's a good question. What if you did give me 50K? Right? Let's discuss that further about what that would look like. Right. And he said, what if I give you 50K if you find a deal? And I said, great. Okay. So I went back, called a local wholesaler buddy of mine, and I said, hey, I need a deal. And so he found, this is right after the crash, right? So right after the 2008 crash, it was like 2009 when things were starting to put themselves back together. And we found two townhomes that were bank-owned foreclosures that this wholesaler found for me. Bought them for $25K a piece, right? Now, this is back in the day. Bought them for $25K a piece. Put another $25K a piece into them in renovations. So it was all in for $100K. Rented each of them out for $950 a month. So my all-in exposure was $50K. Rented out for $950. So pretty much the 2% rule, right? Which is just isn't unheard of in these days. You don't see that anymore. But you also couldn't get a loan on those properties as well because banks just weren't lending back then. So it's kind of a double-edged sword, right? So that was our first deal. And then I refinanced those properties, was able to free up my investors' equity back, paid off the hard money loan that I had as well for the additional money, none of my own money. So refinanced it. And this financial planner from New York says, man, this is amazing. Let's do that again. And then he starts telling a few of his clients about me, right? Not,
Ah.
he did not, he was smart. He didn't just go and pick up a megaphone and start shouting into it to all of his clients, say, hey, forget about Wall Street, come invest with Matt, who's flipping houses down in Trenton, New Jersey. Like let's all do that. He told one of his clients initially, and then one more about this guy in Trenton that was doing some good work for him. And me and this guy were able to raise a couple $100K over time to get work done. So this wasn't like this game changer Manhattan guy that just raised me millions or whatever. He was my first partner that was able to expand with. But then I started shooting some YouTube videos of the work that we were doing. I started broadcasting some of our work. I started writing up articles on online sites like Biggerpockets, and it started to get more and more attention to us. And before you knew it, our track record spoke for itself. And we were able to raise a little bit more money, and then a little bit more money, and a little bit more money. So $50K deal turned into like a $120K deal. And then that turned into a $200K deal. And then before you know it, I raised $50K. This is like years later, a couple of years later, after years worth of track record, we raised $500K for an 18 unit in Philadelphia. And that was kind of where we really got heavy into multifamily, and just light bulb went off, Kyle, because I was starting to realize I was doing a lot of onesie twosie, raising equity from investors and doing a couple fix and flips, then raising equity from investors and doing a couple of onesie twosie burr deals around New Jersey. And it was growing. We got ourselves up to 115 units with again, more of our money and investors' money. But we really hockey sticked when we started getting into small multifamily. And I recommend that to be the first stepping stone for anybody looking to raise capital in the business. It was like a 10 unit, then an 18 unit. And then we stepped up to a 49 unit, right? And then from there, we got into triple digits. We went to 198 unit, and we were off to the races from there. And there's a lot I skipped over in the stories, but I might have talked enough right there.
Yeah, no, I definitely hear you, man. And that's quite the story, of kind of, I do really like, kind of the gradual scaling of jumping from the smaller stuff and kind of leveling up as time went on, and one thing that I did want to kind of poke your brain about too, is when you go to potential passive investors, either investing as equity or investing as debt. Because I had this conversation with a couple investors in the past couple of days, and kind of saw like, both sides to different stories and that type of thing.
Depends on the deal. Yeah. Sorry. We've done both, right? And so there was a time when I mean, and this is like, like my buddy Chad Carlson just released a book, Small But Mighty, right? And I was at one point that investor where I was doing like 2 or 3 fix and flips at a time, and also buying some burr deals and stuff like that, and able to hold it all down because we were buying like 3-4 units at a time, right? Fine. The equation that we used was, if I'm going to recast the debt and refinance it, I'd try and do it with a small short-term bridge loan from an investor. And if an investor would call me up and say, hey, I want to invest with you, I'd say, okay, what vehicle are we dealing with? Because if we're dealing with cash, that is a better investment to do into equity, right? And I'll get into why in a second here. But if they're dealing with a IRA, which many investors have, the better vehicle for them was a short-term bridge loan that I was going to pay, 8, 9, 10% interest rate on. And there was one point I had 4 or 5 fix and flips going on at once. Had a couple burr deals. Those are all good vehicles for short-term loans. But I do not recommend, and I yet again, Kyle, I know because I did it, right? Yeah. Whatever mistake I can tell people, hey man, don't do that. It's only because I literally did it. I did it. And I know it doesn't work because I did it firsthand. Okay.
Yeah.
So it doesn't work. And it is a mistake to take debt on anything you're going to hold long-term, right? From an investor, because and I tell you what happened. We took debt on properties when the market was, everything is awesome, everything's going up, yay, right? Yeah, woo. And then guess what? It doesn't always do that, right? And so we took debt on a few properties that were supposed to be Like market was going 10% a year, man, no problem, right?
Yeah.
And then the market, took a big dip and it took a while to recover. And I was sitting there holding this expensive investor debt on these properties that we had to continue to service over time. And we thought we would grow out of it and be able to refi because, hey, market always goes up, doesn't it? Right. So if you're trying to appreciate your way out of the debt, then that you can't control that. Right. But what I can control is forced appreciation, doing renovation work, buying a total beater dilapidated 4-family and turning it into a really awesome 4-family. I do that. I can sell it, refinance it, and blow that debt out. Right. Then I'm controlling the change in valuation. The mistake I made, Kyle, and the mistake I have seen other people do right now is to put debt on properties where they can't control the change in value. Because if you do that, the market may do what you don't want it to do, whatever that is, and you will end up keeping that debt in place for longer than you want it to, and it'll stunt your growth. So if it's a longer term hold that the market is really in control of your value, equity is what you want because investors will get in, they're on the ride along, they make what you make, everybody wins, everybody has to hold their breath a little bit, that kind of thing.
Yeah, no, I think it makes a ton of sense, man. And especially, kind of segueing into like where we're at in the current market today, and like some of the opportunity that might be coming up, in the next 6, 12,
we're already
18
starting
months.
to see it, brother. I'm already starting to see opportunities. I got one deal right now we're looking at. I haven't seen this equation since like 2012, right? Guy's selling it he's selling it for less than he paid for it 2 years ago. Whoa.
Ouch.
When was the last time you heard of that? Right?
Exactly.
Most of the time they're trying to sell it for double what they paid for it, right? Like, man, I bought it a year ago for 10 million. I want 22 million for it. I mean, how many times have I heard that? I tell my acquisitions guys, my business partner, I love him to death, but he'll approach me in the deal and like, hey man, we got a good deal. It's 100 units, XYZ. I'm like, all right, man, when did they buy it? Well, they bought it 9 months ago. They bought it a year ago. They bought it 2 years ago. Like, brother, no. Because you don't have time, and I don't recommend anybody listening to buy anything that somebody bought a year to 2 years ago at a major bump in value compared to what the seller paid for it. The seller is trying to sell you their problem. If that's what you're looking at, they're trying to sell you a red hot mess that they painted a different color and are putting on the market, right? If you can tell that there's some distress and they're just looking to get out and get clean and go live another day, that's a conversation you can have. But the thing is, Kyle, is if you own a property for a year or two, you don't have time to address real deferred maintenance. You got time to clean it up, to throw some shoe polish on a little bit, right? That's it. That's all you really got time to do to the real estate. You don't have time to really get in and make, real change to the real estate composition or to the value, to the performance, to make it something that's worth really 20, 30, 40% more than what they paid for it. I don't care what the market is or what cap rates have done or whatever, because that all changes, doesn't it? So
absolutely. And you can only juice the NOI so much, especially in a year's worth of time.
You can prop it up. But I can tell you, I've seen, not to get too granular, I don't know if this is how deep you get on multifamily on your show or not, but I'll tell you, are you okay if we go a little bit granular into multifamily valuations? Okay.
Sure, man. Absolutely.
Here we go. Here's the game I see that gets played, Kyle, is that like, man, we got occupancy it was bought it at 82%, got it up to 95%. We've been able to push rents by 15% by doing some renovations or whatever. You started unraveling the enchilada here and getting a little bit further in. And what it turns out that they did was they will claim that they paid $5,000-$6,000 per door in renovations when really they didn't. They probably had the on-site maintenance staff go and give the unit a paint job, okay, which is like, what, $500, right? And then they just pushed rents and we're just going to charge more. And then this is where like the real smoking gun that you see. You got to look at the rental applications for those new units that got leased, because it's common, Kyle, that I see people leasing units to people that are earning 2 times the rent, 1.5 times the rent. That's an equation for disaster right there. You're supposed to lease out at 3 times the rent. So if a tenant, if the rent is $1,000 a month, that tenant should be bringing home at least $3,000 a month, and even better, $4,000 a month to rent out a $1,000 a month apartment, right? And I mean, hey, I don't have any statement on what wages are in this country or whatever, because these are all things I can't control. But people need to be earning enough to afford the roof over their head. And if a landlord's out there renting to people at them earning $2,000 a month and their rent is $1,000 a month, and that happens all the time. There's no law against this. There ought to be, but there's not. But you see landlords doing this, and what happens, Kyle, is like things happen. A flat tire happens. Christmas happens. Your kid has a birthday and you want to rent out the Jumpy House place down the road or whatever, and that's going to cost you $500. Well, geez, that's a quarter of your salary too, right?
Yeah.
Life continues to happen, and tenants keep living life. You can't expect them to just sit at home and watch Netflix, right? They're going to do stuff in their life, and those other things cost money as well. And life also throws you curveballs, like flat tires, or get sick, kid get sick, you lose a week of work or whatever. And so before you know it, all those tenants that are earning 2 times the rent, 2.5 times the rent, end up going into default, right?
Yeah.
And so that is what I see commonly on properties that are propped up right now, where they're just trying to boost NOI a little bit. When you unravel things, that's where the smoking gun normally lies, is in the rental application. So that's my tip. Ask to see a couple rental apps. I mean, the broker should be willing to show this to you. Show me a couple rental applications for people that moved in this property over the last 6 months. Yeah. If they get squirrely with you,
something going on.
Right.
Yeah. No, that's huge, man. Absolutely. And I mean, especially to quote unquote, like boost the occupancy, right? It's like, oh yeah, like that number's there. But in terms of like kind of the quality, like monetarily of that situation might not be there as well.
Yeah. Will they be there in 6 months?
Exactly.
Yeah.
Right after you buy it. Yeah.
Right. And yet again, Kyle, right? I'm not afraid to say it, man. You know how I know to do this? Because I did it. Right.
Been there.
Because I did it the wrong way. And we bought one property years ago at 92% occupancy. Good go. Right. Well, we had we ended up doing 20% eviction in like 3 months because the owner had just propped it up, and we weren't able to maintain occupancy.
Yeah. It's crazy stuff, man. Absolutely.
Yeah.
Yep.
So there.
Yeah. Yeah, totally, man. So another thing that I did really, really like as well, is one of the keys to success that you mentioned in the book was to fall in love with the business. Because along, the similar vein that we were just talking about, like you're definitely, going to be grinding quite a bit. Things aren't going to go well, a decent amount of the time, generally speaking. And like, you just have to like fall in love with it and just kind of keep pushing through the hurdles of that. How has that kind of been for you in the past, of like, I guess just kind of, I call it like kind of earning stripes of like when you're getting kicked around in different ways and just kind of like toughening your mindset, I guess, to continue moving forward.
That's funny. I see people on Facebook writing like, I hate real estate. I love the life that it gives me. I was like, man, that's a crappy life.
Yeah.
That means like if having a really awful job, like cleaning out septic tanks or something like that, paid $400,000 a year, you would do that because of the life that it gives you to clean out septic tanks for $400K. God bless people that clean out septic tanks, by the way. So I'm not knocking that, but that's like just a crazy ass thing to say. Pardon my French. Like, really? That's you hate it. You got to find an aspect that you like about what you do, because you end up spending so many hours in this business. And that, I mean, and as much as I love Robert Kiyosaki, I love his book or whatever. But real estate is not the business of, do 5 hours worth a week and sip Mai Tais on the beach. You can get there, but it takes a lot. You got to put in the 10,000 hours first. Yeah. Right. So, if you hate the 10,000 hours of mastery of real estate the entire time, that's a tough life to lead. But there are different facets of this business that you can fall in love with. I love the people side of it.
Yep.
There are people that I love people that I work with that love the hunter side of this business. They love pursuing opportunities. They love like trying to shake the trees and negotiating and figuring out problems or underwriting or getting in and rolling their sleeves up and turning a thing that looks like this, awful, ugly duckling, and go and, get the drug dealers out and make the property perform really well. And before you know it, the drug dealers are gone. And now there's families and kids playing on the playground.
Yeah.
There are people that love that side of it, and I love that side of it too, by the way. I mean, you see above my head here, it says transforming lives through real estate. That is what we do. Cause I believe that's why I love this business, is because real estate investing as a business affects lives. It affects people. And I love people. And so, and I love being able to make a difference for people. So that's why I love the business.
Absolutely, man. I'm right there with you, man. Like the relationship building aspect is definitely a large, favorite, I guess like passion of mine. And that's the beauty of it, right, man? I mean, like, especially even on like, just like the syndication side or whatever you're doing is like, the thing that's really cool is like, because it's such a team-based sport in whichever like niche you decide to go into, like you can find the partners around you that love, the asset management side, that love the PM side, and you can keep doing, building those relationships, whether it's raising capital, investor relations, or what have you. And it's a beautiful thing, like you can just kind of stay in your lane while still working together,
building a team. And what's funny, I believe in this one. It's probably because I married a really smart girl that got herself into personality assessments as a career, right? Like that's what Liz used to do before we started having kids, and she started the Real Estate Invest Her, right? But before that, she was in personality assessments for 10 years. And she taught me a lot about the different personalities of people, the way people are wired, what makes them tick, right? And I became so passionate about that, and about like that people are different and their wiring in their brain is different, and they function, and things that they're passionate about are different than other people, right? Than others, right? Not everybody's the same, let's say. It became something I was so passionate about that we developed a personality assessment at the DeRosa Group that tells you what kind of real estate investor you should be, right? That's something that we came up with recently that I'm really proud of, that I call it, as you can see on the video here, I'm like a superhero dork, right? So, I got Captain America's shield back there and all that, right? So I called it the DeRosa Superpower Assessment. And it tells you what your real estate superpower is, like what you really ought to be doing to help you thrive in this business. And there's 4 superpowers.
Yeah, no, absolutely, man. It's huge, and I do like that shield back there, by the way.
Well, thank you.
It's pretty awesome.
I'm a dork about it. A huge Marvel guy across the board, superheroes in general, and anything like that. Just that gets me going.
I hear you, man. And no, I mean, to complement what you mentioned, man, like the thing that I do really like as well, about, I mean, just I could say like just like genuine human connection in general. I mean, like within the real estate space, but like just like really other relationships in your life as well, is like just exactly, figuring out like where somebody lies on like a disc assessment or that type of thing, of like, oh, are they more on like the analytical side or like less on the analytical side? Like, how do I, kind of complement to be able to like really build that relationship, and in the way that kind of like fits them, I guess you could say. And like introverted, extroverted, that type of thing.
Right, all that stuff. Analytical, non-analytical, introverted, extroverted, dominant, non-dominant, patient, not patient, all these things play in real estate investing. They play in everything, and that. So like I used to think that I needed to be good at analyzing and underwriting deals to be a real estate investor. Maybe somebody listening right now thinks that they're supposed to be good at that too, right? But the truth of the matter is you don't have to be good at everything. And that's actually a relief and I've had people come up to me and say, hey, Matt, love your book. I just don't want to run around raising money from people. I'm more private. I don't want to go and sell equity or tell people why real estate investing is the best thing since sliced bread. And I want to, I don't want to get out and raise equity. And I say, cool, I got it. Guess what? You don't have to. It's important to read my book to understand how it works, but that doesn't mean that you need to be the lead, because my book's not just it's not like a how-to raise money. It's also, how to structure debt with investors and how to structure equity or whatever. And if you're on a real estate investing team that is using private money, you need to know how these things function, but you don't necessarily need to be the sales force of equity. There are people like myself that love that. It just gets my juices flowing to talk to a new investor, right? There's people that are just not get their juices flowing, but they might want to work with brokers to find deals. They might want to underwrite opportunities that come in and just plug themselves into a cubicle and jump into an Excel spreadsheet and put the deal on a headlock until a business plan comes spitting out, right? There are people that love that. I would have my brain ooze out one of my ears if that happened, right? But there are people that love it, that live for that. And I got one guy that works for my company that feeds his family doing that, they're doing things I hate, and that's great. And I could not put a yoke around his neck and drag him into a room to talk to an investor. Would not want to do that. Not his shtick. He'd love to underwrite deals for the investor though, so there's different passions in this industry, I think.
Absolutely, man. It's a beautiful thing, and that's something
there's a seat for everybody.
Yeah.
Yeah.
And I feel like that aspect of collaboration is always something that has really resonated with me a ton. Like, how can you leverage other people's skill sets that are rock stars in those particular niches and be able to work together to make some cool stuff? You know what I mean? And it's a lot of fun. So one question that I do like to ask everybody on the show, Matt, and I'm curious your thoughts on it, is how do you define wealth?
Oh boy. I had a friend of mine give this to me a while ago. It's he defined wealth as the absence of need.
Ooh.
I know, right? And I just got back from Costa Rica with my family, and it is a magical place. It's a lovely, lovely place. Great people. It's like just a tropical jungle country with, really cool stuff, and not like there's, I'm sure, beautiful homes there too, which we saw as well. But there's also, it's not as posh and haughty-taughty as some of the other tropical countries like Hawaii or states you can go or whatever. It's so beautiful, but it's also great people as well, that live simple life. They say pura vida there. And I met people that probably earn a third of what some Americans do. And I thought I found them to be more wealthy and happy than and these are like fishermen, but they had the biggest smile on their face. Their kids were playing, and they just, you could tell they were living just pure bliss every day, so is that wealth? I don't know. I think that it's a good question. And for those that want to put a dollar amount on wealth, like, oh, well, wealth to me means $5 million in cash sitting in a bearer bonds or whatever. Totally not wealth. Because I can tell you, money, sir, I've learned firsthand yet again, Kyle, money itself does not generate happiness, because I've made plenty of money. And, at closing, big check hits, that's great. But the smile, it wears off, So money is certainly not happiness, and certainly not wealth in itself. But it's really about ownership of time and being able to do what you want when you want to do it with joy. To expand on it a little bit further. And that's what I saw people doing every day in Costa Rica, without millions in their checking accounts.
Yeah. I love that, man. It's always fun to kind of ask that and get people's thoughts, and usually exactly like a lot of the answers that I get are around like overall abundance. And a friend of mine actually said something a while back to me that really resonated. He's like, real estate is just the vehicle to be able to access, the time and the ability to like just spend time with your loved ones. And I'm like, damn, man. I'm like, and that's something that's always sat in my mind. I'm like, like,
what's time? I think that if you want to take another angle at it, right? Like, wealth, real estate investing, all these things are just giving you access to your time so that you can do something that you really want to be doing, right? Whether that's hang with your kids, whether that's pursue another passion, whether that's if you really love building business, continuing to have time to do that without having the time, putting the time to maintain the business that you already have, going out and growing or volunteering or serving others or being philanthropic or just sitting in bliss, on the beach, if that's what serves you, right? It's being able to choose what you want to do with your time without being obligated to do things with your time that you have to do, whether you want to do it or not.
Exactly.
No.
Yeah. It really is an incredible thing.
Mm-hmm.
But heck yeah. So I do have one more question for you here.
Sure.
What is one immediate actionable step for someone on the fence about passively investing in real estate?
Good question. I would at some point, okay, here's an actionable step. But you got to have like an end on this, because you could live in this actionable step for like 3 or 4 years if you wanted to, right?
Yeah.
If you are considering passive investing, then what you want to do is go out and do research, talk to owners, go on their webinars, research them, Google them, right? Go on websites and do research on people, go to their webinars to hear them pitch deals and, talk to some referrals or whatever. And just that in itself will educate you in the space of real estate investing. And also read my buddy Brian Burke's The Hands-Off Investor, book on passive investing, phenomenal book. And then set yourself a deadline on when you're going to get in, when am I going to do something? Because the paralysis by analysis situation is for real, man. It can be that can be a real thing that people can go and get stuck, and they can be getting ready. And I met people at RIA's, Real Estate Investing Association meetings years ago that I'd known them for years, like 3-4 years, and they were still waiting on doing their first deal. It was always something. I'm waiting on the market to crash, waiting on this to happen, waiting on that to happen, waiting on rates to go down, waiting on the, whatever. It's like you're always waiting on something, but it takes a lot more courage, but more momentum. Just get in and figure it out,
Yeah.
And that's really where real momentum is. So that's my recommendation: is get in, do research, but then have a deadline for yourself, like 60 days. In 60 days, I'm going to write a check, to whoever floats up to the top in that 60 days worth of research.
Yeah. I love that, man. And absolutely, it's like just kind of, getting a pretty decent baseline of what's going on, like seeing if it could be a fit for you, if it, what type of thing, kind of fits, like goals and stuff like that.
Get educated, but then take action,
have that cap on there. Yeah. But awesome, Matt. Thank you so much for coming on here, man. This was absolutely awesome.
It's fun. Always fun to talk shop. People want to hear more about us, they can go to derosagroup.com, DEROSA group.com. If they want to take that assessment that we came up with, it is free at derosagroup.com/superpower. All one word, derosagroup.com/superpower. And it is a free assessment. It'll take you all of 5 minutes to take, whether you're a passive or an active. Go online and check it out. And you guys can hear everything that we offer, including really unique real estate education stuff, and also stuff with regards to passive investing, and all on our website, which is derosagroup.com.
Beautiful, man. Thank you so much, guys. Check out the new Raising Private Capital book on Amazon as well that dropped yesterday.
And I'm required by Biggerpockets to say, if you read the book, please write it a review.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs. Get access to our private investor portal and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.